Good afternoon and welcome. Thank you for joining us at today's webinar as we continue our educational series for credit union members. My name is Angel Santos, Assistant Vice President and Relationship Manager for Credit Unions at the Federal Home Loan Bank of New York. Frank Ferrone from Darling Consulting Group will be providing today's presentation, which will address interest rate risk, liquidity, and the mechanics and impacts of the net economic value supervisory test. This session will give our credit union membership the tools they need to overcome challenges and make the most of many opportunities that 2019 will present. If you have any questions during the presentation, just type them into the question box on your screen, and Frank will answer your questions at the conclusion of the presentation. It is my pleasure to introduce the presenter for today's webinar, Frank Ferrone. Frank is Managing Director of the Darling Consulting Group. Frank consults with CEOs and CFOs of financial institutions across the nation, helping them increasing earnings through proactive management of their capital, liquidity funding, and interest rate risk. He is a frequent speaker and author on topics such as industry issues and trends, funding solutions, regulatory issues, IRR management, capital management, and derivative hedging techniques. Frank was designated a top-rate speaker by the Financial Managers Society and is well known for his program seminar, Turbocharging Your ALCO Process. We at the Federal Home Loan Bank of New York have invited Frank to speak to our members and internally at the bank many times, and his insights are always appreciated. Frank is a graduate of Siena College. He lives in Winchester, Massachusetts, and is an avid golfer, skier, and running, having completed numerous marathons, including the Boston Marathon, over the last 25 years. At this time, I will turn the webinar over to Frank.
Thank you, Angel, and welcome everybody. One of my favorite marathons is certainly the Boston Marathon, but I've run the New York City Marathon a number of times too, and it's always a thrill. And coming from upstate New York in Saratoga, I feel right at home with the group, and I always feel right at home with the folks from the Federal Home Loan Bank of New York. We've got a lot of stuff to cover today. Hopefully many of you have listened in and attended some of the things that we've done in the past, because I'm going to hit certain things, at a high level, with I'm assuming that you have a basic knowledge of a lot of the things that we've talked about in the past. So let's get right into, what some of the biggest challenges are for the credit union industry, and what are some things that we ought to be thinking about from a strategy perspective. There's going to be a little bit for everybody in here today. Some things are going to may pertain to you and others not. So that being said, I think the economy and where we are from an interest rate risk perspective impacts every single one of us. How we manage and how we deal with it is going to be a little bit different. If you think back to where we were, the last webinar I did was about 3 months ago for you folks. We've had a pretty dramatic change in interest rates and the outlook. If you think back to October, Powell had that, smirk on his face. Hey, we're a long way from neutral. We're on autopilot, and the markets were expecting maybe another 2 to 3 rate hikes in 2019. It was kind of baked into the cake. And then what happened? In November, I guess the sentiment was we're pretty close. We're just below neutral. And again, maybe another 1 or 2 Fed hikes until more recently, we've got to be patient. And Powell had a 180-degree turn most recently. And that's what we call the Powell pivot. And all of a sudden now, maybe we don't have any more rate hikes in 2019. And the markets, in fact, are predicting 0% Fed hike in 2019 and a much higher probability of a rate cut the farther we get into 2019 and 2020. One of the things that I've shown you in the past is rate cycles. And one of the things that we've talked about at the last several sessions that we've done together is how do rates typically move? And what happens if and when, we do have a continued Fed rate hike. What can we expect? If you look all the way over to the right here, this is about where we are today when we look at the 2-year point of the curve and the 10-year point of the curve. We're coming close to zero in terms of spread. Today, I think we're about 250 on the 2-year, 266 on the 10-year. So it's about 16 basis points. The big question is, do we go inverted? We're already inverted at the 1-year point of the curve. If you look at Federal Home Loan Bank advances, 2-year borrowings are cheaper than 1 year, right? And we'll take a closer look at that later. But one of the things I want to draw to your attention again and remind everybody of is if we look historically at the spread between the 2s and the 10s, one of the things that you notice is when we go flat, we typically go negative. And once we go negative, it's not very long before, it's probably 8 to 18 months, we invert. What happens after we invert? We go into recession. And then what happens? The Fed cuts and we get a steep curve. And then what happens? Eventually, right, the Fed hikes and the same thing happens. And so one of the things that we learn, historically is, the Fed has been over tightening. It sends us into recession. The Fed cuts and we start all over again. So one of the things that we need to be very careful of is that when we get into this inverted yield curve, it's very tempting to extend funding because it's cheaper than short funding. And conversely, why would I go out 10 years when I can go out 2 years and get the same yield or better? Well, here's why. Because shortly after we go inverted, right, short end of the curve gets cut. And the bond market recognizes that, and that's why long rates start to head down, right? Everybody wants to lock into those longer-term yields before we go into the proverbial rate cut, right, recession. One of the things that we also note is if you look at where we were back in 2007 when the curve was inverted, right? Look how fast we go from Fed tightening to Fed cutting. And you see that cycle after cycle. Conversely, if you look at once the Fed cuts, right, and this is now we're looking at, 2008-ish, look how long we stayed down here before the Fed started to raise rates. So even though the Fed last raised in December, you know what, we might see a cut in the not too distant future. But again, rates go in cycles, that's important. After the curve inverts, right, we tend to have cuts. And so that brings us to, where are we today? The last time we were together, right, was about 3 months ago. And one of the things that we talked about was we might be at a peak in rates. Don't wait until the Fed is done raising rates before you think you can now start to lock into those long-term yields. Long-term rates don't wait for short-term rates. And so this is a major problem for the industry and particularly the credit unions. And that is these long rates are coming screaming down. And so the question becomes, what do we do now? And that's where we're going to spend a lot of our time today. What are some things we ought to be thinking about? Did we miss it? Is it too late? And then we're going to talk a little bit about that whole NEV issue that impacts each one of us a little bit differently. So last quarter, what did we talk about at the Federal Home Loan Bank of New York Credit Union session? Some of you at the time may have looked at this strategy and said, I would never do that, right? Why would I go out 30 years on a mortgage-backed security when we're in the middle of a Fed tightening cycle and it looks like the Fed's going to continue to raise another at least 3 times in next year? Well, look at the difference. Today, we can't get anywhere near 4.05% on a mortgage-backed security. If you look at the interest rate risk profile of this institution, right, our biggest exposure is to falling interest rates, right? We have a little near-term exposure if rates go up 2, but what's the likelihood rates are going to go up 2% in a parallel fashion from where we were, right? So this was a strategy that we looked at last quarter. Unfortunately, those same yields today are probably 60 to 65 basis points lower. And you can't get these at discounts anymore. They're at premiums. So the question becomes, what do we do now? Is it too late? Well, think about where mortgages are today. I was on the phone with I had a meeting this morning with a client that is doing 30-year fixed rate mortgages at 1/8 below everybody else in the market because they're trying to grow volume, and it's working. And I will talk a little bit about what they're doing on the funding side later on. I've got an example in here, but we can't get these yields anymore on the mortgage backs, but we can certainly get as good or better, all right, on mortgages. So think about that as we go through this. Do we have capacity to consider holding on to some fixed rate mortgages, which most credit unions don't like? I know the NCUA doesn't like them. And again, we've got some NAV issues that we have to, factor in. This is where we were last quarter. The last time we met, we were right here, right? Look how far it's come down, right? That's a big decline in rates. Okay, let's look back at where rates were, where they are, and where I think they might go, and how it's going to influence your decisions as to what you might do on the funding side and on the asset side. This was the best of times. 2013, we had Fed funds were basically zero. You could borrow at the Home Loan Bank for less than 25 basis points. A lot of you took advantage of some of the strategies that we looked at in terms of, and if you didn't hear from Angel and Tom Citino, you weren't in the business, right? They looked at doing what we'll call arbitrages, where you could borrow short, invest short, and make a positive spread given the dividend. That's come and gone, but look how steep the curve was in 2013. Long rates were high, short rates were low. And we had that same benefit for a number of years, 13, 14, 15. And then the Fed started to raise rates, right, to where we are today in this flat curve. But most of the volume, right, that we booked, whether it was mortgages or auto, was probably right around the 5-year point of the curve, right? What's happened now is that short rates have come up. The curve is flattening. We still have some residual assets on the books left over, but once these things start to reprice, right, now we're looking at repricing off of this point of the curve. The problem is, we don't have that same level of slope, right, and our funding costs are continuing to head higher. So the question becomes, should we continue to put on assets in this low rate environment? I think the answer is yes, because the bigger risk is rates don't go. So if you look in your gap report, you're going to start to see a lot of cash flow pouring in over the next 12, 18, 24 months. The bigger risk is that rates don't go higher, but they come lower. And again, we're going to talk about what are some things that we'll be thinking about. This again goes back to previous rate cycles just to show. This was before the Great Recession, short rates higher than long rates, right? A lot of people fell into the trap, I'll call it, of extending out long on funding and staying short with assets. And then look what happened. And we know what happened even farther than that. We came down to a quarter. Same thing happened back in 1999, 2000, before the new, millennium, right? Flat to inverted curve, and then bang, we went into recession. Let's not forget that the greatest exposure that credit unions have and banks is a falling rate environment. So we don't want to get sucked into, right, making decisions based upon the shape of the curve that are going to be counterproductive if short-term rates fall. Okay. In terms of the credit union industry, I've got some trends down here. And the most important thing to understand right now is that for most of us, loan growth has been outpacing share growth. And so the question becomes, at what point do we start to get a little concerned or nervous that our loan to asset ratio or loan to share ratio is climbing? Some of us have policy guidelines that get in the way of us doing things that are in the best interest of our balance sheet, because we tend to look at ratios. We look at cash and short-term investments as liquidity relative to our assets, and what's happened? That's coming down. One of the biggest issues I see right now in regulatory exams for credit unions is they're getting criticism because of their short-term investments and cash relative to assets. We all know that whether you put a 30-year mortgage-backed security I showed you a little while ago on the books, or we put 30-year mortgages on the books, if we have access to the Home Loan Bank, which all of you do, right, I can pick up the phone right now and borrow against those investments and those mortgages. So how you measure and manage liquidity is going to be critical. We've gone over that at every single session we've done, so I'm not going to spend a lot of time on that, but just make sure that all your policies are up to snuff and that the way you measure and manage liquidity fits your overall balance sheet strategy, all right? So what are our big issues? Cost of funds are going to continue to rise no matter what we do because short rates have come up and everybody seems to want to gravitate to the short end of the curve, and people are moving and migrating out of our non-maturity deposits. We all know that. So the question becomes, what do? We have to continue to grow to offset that funding pressure. And this flat to inverted curve that we talked about, we have to protect against falling rates despite how narrow the margins might be incrementally as we move through 2019, right? Liquidity, again, it's a big issue. And more than anything, credit quality is absolutely critical. And unfortunately, you know, the regulators tend to push us into higher risk assets because they look at everything long-term as being bad. It gets counted against you in all these NAV tests. So we're going to spend some time on that as well. So let's go into deposit betas. I showed you something similar to this last time we met. The important thing here is these are short-term interest rates. This is Fed funds. All right, so if we went back to before the Great Recession, which bang, hit us here, what happened? Rates went up, 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 up. We lagged on our deposit rate movement. Right after the Feds finished tightening, right, they cut hard. But look at what happened on our funding costs, right? They continued to lag on the way down because why? We tended to lock into a lot of longer term funding. The question becomes, what can we learn from the past? When we look at previous rate cycles, and we've done this for many rate cycles and it's relatively consistent with what we've seen in this period and what we're seeing now, is the first 125 basis point of rate hikes, right? Betas, right? How much we moved our interest-bearing deposits was about 9% in that rate cycle. How about this cycle? If we look at the same rate movement, it was 8%. So you've been able to lag considerably up until recently. I think we've reached the tipping point where now we're having to start to pay up for funding. Right? If you look at the second 100 basis points, so now we're up 225. It was 31% last period. This period, what have we done? 11. The good news is we might be at the end of the rate hike cycle, so we're not going to see that big jump for the next rate hike, the next set of rate hikes. If we're at the end, then we have to start thinking about, right, the next cut in rates. So just, you know, keep that in mind when it comes to looking at your betas. One of the things that has been a top of mind issue for all of us is rising rates. And the reality is we can't become so fixated on rising rates that we forget about your greatest exposure is falling interest rates. So let's talk about what I consider to be 5 of the most common, I put missteps, that's a polite way of saying mistakes, right? And one of the things is we tend to focus on interest rate shocks instead of ramps. Why is that important? Secondly, we tend to look at 1 to 2 year time horizons. You know, a lot of you have come a long way in terms of looking at longer term horizons, right? If we were to focus specifically on, you know, rising rates, right, and concern about rising rates, what happens is we don't see what happens once we get beyond that 2 year time horizon. So here we have an asset sensitive institution, their exposure is to falling. Over here, we have a liability sensitive institution, right? In a rising rate environment, they get squeezed, falling rates is their friend. And then we have some where it's a little bit of both, right? They get whacked in the near term, whether rates go up or down. If we look at a longer term time horizon, we get a very, very different picture. So whether you are asset sensitive out of the gate and you have exposure to falling, or you have a little near term exposure to rising rates, the reality is all of us, our greatest exposure is to falling interest rates, and we ought to be taking advantage of rising rates. Now, I'm going to talk a little bit more about NEV later, but I don't think there's anybody on today's call that doesn't have capacity to add long-term assets. And that's where we're going to spend some of our time today, is how do we defend that position? If I were to only look at this particular credit union and I look at bar graphs as rates unchanged, this is up 200. What's the possibility or plausibility of rates going from where we are today with an inverted curve, a Fed on hold, that we're going to see rates go up 200 in a parallel fashion? Probably about a 0 probability, right? If we look beyond that 2-year time horizon, now what do you notice? You know, once I get beyond that 2-year time horizon, life is pretty good. If we don't factor that in, we're going to tend to make decisions based upon a liability-sensitive institution. We're going to do exactly the opposite of what we ought to be doing from a balance sheet strategy perspective. Why do we use ramps versus shocks? Because that's the way rates tend to move. And you've seen that when I've shown you how rates move over time. Here's something that I've used with clients and particularly with regulators, and that is, you know, you're asking us to run instantaneous 300 basis point shocks for earnings and for NEV. The reality is, and look, there's our recessions, right? Rates tend to move in cycles, right? Number one. Number two, the average annual change in Fed funds, if I went all the way back to 1970, it's plus or minus 160 basis points. And what you find is the farther and faster rates move up, the farther and faster they come down, right? And I think these things are important to show not just regulators, but ALCO and board members. It does make a difference. Rates don't go up in a shocked fashion. And unfortunately, that's a major issue in the credit union industry, more so than the banking industry, because you have this new NEV thing that we have to deal with. Okay. When it comes to having fixed rate capacity, whether you are liability sensitive in the near term over here, or you're pretty well matched, or you're asset sensitive, there isn't anybody that doesn't have ability to add fixed rate capacity. The challenge is your awareness of your capacity varies depending upon what your model shows and how far out you go and what scenarios you run. Your appetites vary. I have clients that look like this, and to get them to go out long term, it just doesn't feel comfortable. They don't want to do it, despite the fact that their biggest exposure is to falling interest rates. And then sometimes biases get in the way, both at the senior management level, the board level, and now it's this whole NEV thing, which again, we're going to talk about, but that's a major issue right now, and it shouldn't be. Okay. Investment strategy from our last FHLB webinar. I pulled this out of what we did before, right? And again, this is rising rates, this is falling rates. This is a steep down too. And for the clients I work with, I'm saying, look, whether rates stay the same over the next year or two, or we get a steepness to the curve where the Fed starts to cut, maybe we're somewhere between the two, we want rates to rise. Unfortunately, it doesn't look like it's in the cards. So how do we manage against that? And again, I did this, you know, as of last October, right? You know, long mortgage backs funded short. The important thing is to see, you know, what's the impact to our income and to our balance sheet. If rates go up, we're better off versus doing nothing. Base case, we're better off. Falling rates, we're significantly better off. But of all these scenarios, which one would we want to have materialize? And I only went out 3 years. It gets better beyond, you know, the longer out you go. We want this one to materialize, be up 200. And even though that's the least amount of income from an incremental strategy perspective, what that means is look at 3 years out. 3 years out, we're printing money. I don't care about this strategy. So again, just something that we looked at last quarter, 96 cents on the dollar. Those are at premiums now. Okay. How you present at ALCO, your risk profile presentation, it matters. You know, this, if I only looked at a 1 year horizon or looked at a 1 year gap, we'd look like exposure to rising rates, right? If I look 2 years, again, it looks like we've got exposure, you know, to a rising rate environment, right? If we go longer term now, what do you notice? You know, we've got plenty of capacity to put on long assets and go long. Our greatest exposure is to falling rates. So the question becomes, do we have capacity for long assets? What's our risk profile look like? If you don't think so, the question becomes why, all right? All right, here's a liability sensitive institution, near term. Everybody at some point becomes better off in a rising rate environment. What are some things that we ought to be thinking about from a liability sensitive perspective? Well, we go longer out on the curve, right? With either funding or CDs. What's the problem with that? That's been very expensive. And what we've said all along is you're better off paying as you go. Continue to ride the short end of the curve if you look like this. That's not exposure to rising rates, right? How far should I extend? How do I pay for it, right? What if I don't have borrowings on the books? How do I extend my funding? If you go out in a CD environment, it's way too expensive to now go out and get long-term CDs. You're better off riding the short end of the FHLB curve. For those of you that are fixed rate lenders, right, it might not be conducive to generate floating rate assets. I'm going to show you how you can take fixed rate assets and create floating, right? But if I'm liability sensitive, these are things that I might be thinking about. But if I do extend out on the curve today, I don't want to create a falling rate problem by going out too far. So I'm going to show you a couple of different strategies that we can consider. NEV, that's a major, again, issue that we're going to have to deal with. If you look like this and you want to continue to add fixed rate assets to the balance sheet, make sure you understand the impact to not just NEV. NEV is not a problem. The NAV Supervisory Test is the problem. And I'm going to walk you through right now why I believe that is the case. And here's something that you should all know. We have been pounding the drum on this whole regulatory supervisory test. We have gone to Washington. We've spoken with them. We've met with them. And I can tell you that it came as a surprise that this was an issue at the NCUA level. And we continue to have discussions with them, and we're going to be going down and meeting with them again. At the end of the day, you need to understand this, and you need to be able to defend your position. I don't know if there's anybody on this call today that is at extreme risk. I can tell you right now, I'm dealing with 7 credit unions that are at extreme risk. And when you become extreme, it's not good. It's not good, and you have very little ability to negotiate. So I'm going to show you how you get out of those situations. I'm meeting with NCUA and a client on Monday night and the full board to go through what they call a de-risking plan. I had a meeting last night, same thing. So I've spent inordinate amounts of time trying to help credit unions get through this, what I'll call nightmare. Think about when you run your NEV, your longest assets get whacked the most, right? From a value perspective, your core funds, right? Your non-maturity deposits, most of you have an average life of over 7 years on your non-maturity deposits, in which case those are the funding sources that support those long assets. Unfortunately, this new calculation doesn't give you credit for those funding sources. That's the problem. So think about what's happened. I showed you early on how the yield curve went from, very, very, I'll call it, high yield steep, right? Back in October to where we are today. Now, I would bet if every single one of you looked at your earnings over the next year or two, back in September and October, it probably showed life is pretty good, given that steep curve and a 10-year treasury in the 320 range. Now, your NEV didn't look so good. You roll the clock forward to where we are today. The 10-year rates have come down. Rates have come down across the board, with the exception of the short end. So all of a sudden now, our NEV looks a heck of a lot better. Well, yeah, because you don't get whacked by as much as you did before, because long rates have come down 65 to 70 basis points. So that's why I say, as these long-term interest rates have fallen, that's NEV nirvana, because now my NEV looks much better. But my income doesn't look so good, right? That's a nightmare. So the question is, yeah, it's helped both our NEV, but it's killed our earnings at risk. So let's take a look. And I'm not going to spend a lot of time going through a lot of the detail here, but what is the supervisory test? I have credit unions that I've spoken with that say, Frank, I don't even know what this NAV supervisory test is. I said, you got to be kidding. You don't run this every quarter? No, we don't even know what it is. Well, the NCUA in its infinite wisdom came up with what they call prescribed premiums. You notice it's not average life, it's premiums on these non-maturity deposits, non-maturity deposit shares, right? This is what they give you. In the base case scenario right now, they're going to give you a 1% premium. Let me ask you a question. If you pay 15 basis points on a checking account today, or excuse me, not a checking account, all your non-maturities between checking accounts, share drafts, if you're paying 15 basis points, and I have a client that I have to meet Monday night with the regulators, they've got a majority of their funding in non-maturities at 15 basis points. If I had to borrow money on an overnight basis today, it would cost me probably around $260. So if I had to do, what's the value of a non-maturity deposit at 15 versus a 1-year funding source at 260? Say, well, you pick up, heck, 245 basis points, right? So, heck, even if those deposits stuck around for a year, you save almost 2.5%. So I would say it's worth at least a 2% premium if it only lasted a year. What do you get in this new test? You get 1%. So in other words, the average life based on that premium is less than 6 months. Is less than 6 months. Okay. Now, if rates go up 400 in your NAV calculation, you get a 4% premium in that 300 shock. But you really don't, and I'm going to show you why. They have a little matrix here. Here's the problem. A lot of the credit unions are migrating to high risk and extreme risk, and I'm going to show you why. So all the premiums, whether you have premium money market accounts at 1.25 or share drafts at 5 basis points, they both get a 1% premium. How ridiculous is that? Okay, your non-maturity deposit premiums are fixed based upon these prescribed premiums, right? And these premiums are just unrealistic. I don't think they thought this thing through. I know they didn't think this thing through. All right? Here's a case study. Let's look at this credit union. What's their biggest risk long term? Falling 1, falling 2. That's their greatest exposure. Over time, and by the way, that's an up 1, up 2, up 3, up 4. What is the reasonableness of an up 2, up 3, up 4? Come on. Even if that were to occur, ultimately, long term, life is pretty good. This is our greatest exposure. But this particular institution is at extreme risk from an NAV soup test perspective, right? Once again, if I do a reasonable, rational, running rates up in a ramp fashion, I draw the line across here from base case income, right? I recover after 2 years, and then life is good, right? If I look at this particular credit union, right, and I look at their earnings at risk, from where we are today in the base to the down, our maximum exposure is $1.5 million, right, in the flat up 2 over 24 months, right? We're not going to see that. But even if we did, we're fine. We still make $5 million a year. What's wrong with that? How can I be at extreme risk, right? So let's take a look. This is a NAV calculation before they change the rules on us with this new soup test. I've got a deposit study that says my average life in non-maturity is about 6.5 years, 6.4, right? So you can shock rates up 1, 2, 3, 4, and you know what? I've got very strong capital. I'm within my guidelines, right? I'm okay. Now, let's take the NCUA supervisory test, okay? Now, all of a sudden, right, this shows that I'm basically out of business if rates go up 300. Remember we looked at the income? The income, they were fine. After you got beyond 2 years, that was the best case scenario. What the NAV supervisory test says is, you guys are at extreme risk, and your best case scenario is falling interest rates. How can that be? Now, if I've got non-maturity deposit costs at 43 basis points and a 1-year borrowing at the time was almost 3. You're telling me that's only worth 1%? Well, here's what we're going to do. All right, I'm going to show you why. If I take the base case scenario where they give us 1% premium, and I bring rates up 4%, right, up 300 basis points, I should get a 4% premium. 4%. Okay, well, let's see if that's true. This is the case of the sign at the bar that says free beer tomorrow. What happens if you come back tomorrow? It says free beer tomorrow. You never get your free beer. If I look at this supervisory test from 2 years ago, what it suggested is, right, these things should be down a little bit. In the base case scenario, if rates go up 2, I get a big premium. I get a big premium. The problem is, I roll the clock forward 2 years, I don't get that premium. Because now the up 200 scenario, I'm right back to my base. You start all over again. You get 1%. Wait a minute. Back here, you said if rates go up 2, the value of those non-maturities is $16 million. Rates went up 2. Where'd the $16 million go? You start all over again. That's the problem. That is the problem. So if I look like this, the question becomes, okay, how do I fix it? How do I fix this situation? Well, the only way you can do this is you get a couple of choices. You can sell off all your long assets, and at the time, we take a loss. You can lengthen your wholesale funding, but I don't need long-term funding. I am not exposed to rising rates once they get up beyond 18 months. So the question becomes, how can this be fair? It's not. It's a flawed problem. It's a flawed calculation. So this is what I have to present to the regulators on Monday night. Here's how we get out of this thing. I got a couple of choices to back into how to get out of extreme risk. I could put on $75 million of fixed rate funding out 5 years, right? And if I do that, right, this is what my net interest income looks like versus here. So I take that little dip out, but that's against 200 and 400 basis point changes in rates. Come on, right? It exacerbates my exposure to falling if I extend my funding, but doesn't matter. They don't care about income. Here's what happens when I do that. And in this case, I just did a 5-year interest rate swap because I don't have $75 million of funding that I can extend, right? So I'm going to do a 5-year swap, and then look what happens. Abracadabra, I fix the problem, and it puts me at moderate risk. Here's another thing I can do. I don't want to put $75 million of funding on 5 years because if rates fall, that kills me. What else can I do, right? In this case, what if we did a 15-year funding? I don't have to do as much as I would if I did only 5 years. So what I can do in this case is I can go out 15 years. I can borrow 3-month money at the Home Loan Bank. I can put on a 15-year fixed rate interest rate swap at 261. I'm going to receive floating. My net cost is 264. That should be moved over. Right? 264. And that doesn't even count my dividend. If I factor in the Federal Home Loan Bank dividend, that's about 246. I get about 18 basis points. 246 for 15-year money fixes the problem. How do I know? And by the way, I don't have to do 75 million. I only have to do 50 million. All of a sudden now, this is what my income looks like, and this is what my NAV looks like. The higher rates go, the better off I am. That's how you fix this. And by the way, there are a number of credit unions in the Federal Home Loan Bank of New York district that I've helped through this, and this is what we did. Some of them we did 7 years, some of them we did 10 year. Nobody's done 15, but at this point I might, for these guys, this is what I might do. This not only gets us out of that supervisory situation, but now, where's the greatest exposure to this credit union? Once I do this, they are now at significant risk to what? Not rising, but falling. So, why is this important? a lot of credit unions were sliding down. I don't think they are. I think they were sliding down the risk spectrum until this fall in long-term interest rates. If rates continue to rise, it's going to become a bigger problem. And then you're going to have to go through this de-risking plan. And if you fix the problem, right, which isn't really a problem, you're going to exacerbate your exposure to capital because, number one, it's going to cost you more. And if rates fall, that's going to have a negative impact on most credit union income. So it's basically counterproductive. I've got to put this presentation together again for the regulators and go down to Washington to present this because I don't think they all grasped it the first time. So some of us, right, fixed rate lending or fixed rate investments, we just say, no, don't want to do it. Doesn't fit our policy. We're not comfortable with it. Certainly not at these low rate levels, despite the fact that we know our balance sheet can support it and we should be adding duration on the asset side. A lot of things get in the way, whether it's a bias, whether it's the NAV, whether it's policies, but either way, right, I'm going to show you, this is a credit union I just started working with probably two quarters ago or 3 quarters ago, can't remember, but I'm going to walk you through, right, their particular situation. Here we are here. We're looking at their liquidity. Their liquidity is relatively low. And you know the regulators always want 10%. This is the approach I've walked you through at every single one of these webinars, seminars that we've done, all right? And you can adopt it. It's basically looking at cash and cash equivalents. Now, some of you, right, if you had a liquidity position like that, you'd be way out of your policies because of the way you look at cash and short-term investments. We don't need to carry a lot of liquidity in cash or short-term investments. Why? Because we have access to Federal Home Loan Bank. This one happens to be in Boston, right? I've got all this loan collateral I can pledge. And so when I look at all the loan collateral, I know I can pick up the phone, access funding. I'm not going to carry a lot of cash. I don't need to, right? If I look at the 90-day forecast for this particular institution, and I look at what have our loans been over the last quarter, and they grow. They're holding all their fixed rate mortgages now, by the way, which they didn't do before. They brought in some deposit flows, right? How come? They paid up. And you know what? The first thing we did last quarter was we cut these rates. They were paying 3% on CDs. We cut those by a lot. And what we also did is we shifted from two and I think it was 25-month CDs, whatever, at 3%. We came out with a 7-month CD at $250, and they're doing very well with that structure. And for their risk profile, that's what they need. I said, you're saving 50 basis points versus 2-year at 3. And think about the break even on that. Where do rates have to be 8 months from now before it made sense to add 3% money for 2 years versus 7 and 8 month CDs at 250? Do the math. So that's what we did. And you know what? They've done pretty well. Okay, look at their interest rate risk profile. They are asset sensitive. If the curve steepens, they do great. It's the falling rate environment which pinches us. So what do? Right? They do great from an interest rate shock perspective. Once again, falling rates is our issue. Again, this is something that if I go back here and I show you this, why do they do so well when rates rise and why do they get smoked when rates fall? Here's why. And I know we've done this at every single one of these, and I know, you know, Angel and Tom Centino have been preaching this ever since we walked through this the first time, and that is all of the credit unions on this line, you have a lot of capital, you have DDA, you know, non-interest bearing funds, you've got NOW accounts, you've got share accounts, a lot of long-term non-rate sensitive funding. You don't have a lot of long assets. So if I compare my long assets on the books to my long funding, there's a mismatch. And you're funding a lot of short assets with this long funding. That's why your interest rate risk profile looks the way it does. If I've got $400 million of excess, low cost, zero cost funding, that's not funding a long asset. By definition, it's funding something short. How do we fix that? We extend out on the asset side, right? This particular, again, credit union, we just started working together, and when I looked at the investment portfolio, I looked at all of the assumptions in the model. Where's all the cash flow from the investment portfolio going? Short-term callables, 3 non-call 1. We like those. I don't like them. I would never buy a callable bond, right? Ever, 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 right? What if we went long with investments, even at this point of the rate cycle? So I just said, what if we put on long-term mortgage backs instead of callable agencies? We're better off in every single situation. So I got the board to approve. We took callable bonds right out of the investment policy. It's no longer permitted. What else did we do? What if I rolled all my investment cash flow, all of it, instead of going into investment CDs, which I know you all like? It's short term, the regulators like them, it's easy, it's simple, but you can't afford to do that, particularly if rates fall. You're better off going into long-term securities. You can replace these long-term securities with mortgages, right? Look at the difference by shifting out of these short-term investments and callable bonds into long-term securities. Major, major difference. Now, this may not fit your liquidity profile because of the way you measure liquidity. Cash and short-term investments. I don't care if it's a 30-year mortgage back or overnight funds. As far as I'm concerned, I've got the home loan bank. It's the same from a liquidity perspective. Again, you may have to change that. Let's look at their NEV. We did a core deposit study. They had one done before. It was 6.5 years. We came up with 7.6. So what, right? Look at their NEV. Their NEV looks perfectly fine. Let's look at the NAV Supervisory Test. Oh, no, back up. We take 6.5 or 7.6 years. I cut that in half. This is what we call a stress test. I cut it in half. They're still fine, right? They're at minimal risk. Using the rules from the old days, or this is what banks have to do, right? Citibank, Bank of America, Bankers Trust. This is what they run, right? This is their Eve. All of a sudden, NCUA comes around and changes the rules of the game, right? Now we got to do the supervisory test. Oh, well, now what? Oh, we look terrible if rates rise, even though we're printing money and making record profits. Our best case scenario from an NAV supervisory test is falling interest rates. This is a major problem, folks. I'm sorry to beat this thing, but if you're in the low to moderate risk category, you're probably saying, why are we wasting our time on this? If you're at the higher extreme, this is the reason why. You need to be able to defend it, right? And I've gone through so many of these things now. I've almost got this thing perfected. So if anybody is struggling with this, just let me know. Give me a call. Here we are at the end of our session today. What are some of the key takeaways? We've talked about a lot. We've talked about interest rates. We've talked about the shape of the curve, where the Fed might go next, liquidity. Most of you have a ton of liquidity and access to liquidity. It just comes down to how do you measure it? How do you manage it? Having access to the Federal Home Loan Bank, you guys should have plenty of liquidity. You don't need to keep everything short. How do we squeeze more out of our lending, right? Think about how much capacity do I have to add fixed assets to the balance sheet? I give you that very simple core funding utilization. Angel knows this inside out and backwards, as does Tom. Have them help you through this. You don't need to hire a consulting firm to help you with this. I just gave you, right, a template to use. Derivatives, right? If you think that you're going to fall into that high risk category, you are in that, right? I can tell you right now, getting set up for derivatives is a very simple. It's not simple. We put together a process, which I will share with you how you go about doing this. If you're federally chartered, very different than if you're state chartered, very different from if you're national, right? But we're getting to the point now where like 90% of the way through on putting together a process that's really simple to follow, and I'll give it to you. All right? Revisit your wholesale funding strategy. Should we be going long because it's cheaper to go long than short? Probably not. Revisit your policies. By the way, what is a reasonable policy for wholesale borrowing? Most of us have probably 10%. I can tell you my credit unions, and I don't know if any of them are on the line right now, my recommendation is I would go by NCUA policies. What's that? 50%. 50% of shares in unimpaired capital. That's not my rule, that's NCUA, right? If you want to have an internal policy guideline, I don't know, 35%. I would start with 35%. You may never get there, but I like 35%. It's less than what the regulators allow for, number one, and it gives you a lot of wiggle room from where you are today and 35%. Because if we're at 10% policy and you get up around 5 or 6, what's the natural tendency? Ooh, keep a little of that Federal Home Loan Bank borrowing capacity dry, right? You don't keep anything dry, right? It's too expensive, all right? Contingency liquidity. We've gone over that. We beat that thing to death in the last several sessions we've done. If you're struggling with any of this stuff, give me a call. I'll give you the stuff you need, all right? Maximize your availability at the Home Loan Bank. And don't forget the dividend impact, 6.90%. I don't know where that falls relative to the other home loan banks, but it's got to be among the highest, if not the highest. You guys are fortunate in that regard. Funding can vary greatly in cost. You know, why do I want to go out and pay up and compete at 3% in my local market, right, when I can pick up the phone and get money around 2.5% at the Home Loan Bank? Right? You got to make that decision, right? I would shorten up my CD specials. I would try to get money between 7 and 9 months versus going out and chasing 1 year, 2 year, and 3 year CDs. It's too expensive. And human nature is more people will gravitate to a 2.5%, 9 month, 8 month, 7 month CD versus going out 3% for 2 years. How do I know? I have a client that we switched everything, and they've got 3% handles in their market. Their customers are gravitating toward the 2.5, 8 month CD. Right? Okay. What else? NAV Supervisory Test. You know what? I went through that pretty quickly. Hopefully, if nothing else, it's giving you an appreciation for why I think it's such a ludicrous, ridiculous test that wasn't well thought out. Hopefully, it'll change. But don't forget about falling interest rates. That's your biggest exposure. There's lots of ways to manage against that, but the most logical thing, in my opinion, is continue to add duration on the asset side in the form of loans. If I were a credit union today and I were looking at investments, one thing I would not do is pay a premium. I would not buy callables. I would look at DUS bonds, DUS. And if you don't know what they are, talk to Angel, talk to Tom, call me. I'll help you with those. You can get 3 and 5 years today at pretty decent prices. In effect, what you're buying is commercial loans in the form of a mortgage back that are guaranteed, and they have prepayment penalties built in. So if those things prepay, you get a prepayment penalty on the investment. I mean, most credit unions don't even know these things exist, right? And you can get a yield that's as good or better than a 15-year mortgage back, going out 3 to 5 years. And then last but not least, and I'm biased, obviously, ALCO. ALCO is where we make all these decisions. It's a profit center, right? That's where we make a lot of these decisions based upon our risk position. And so at the very end of this presentation, I think I put in here, here's a special offer, right? And that is for everybody that's on this call, right? If you want a complimentary, one-time strategic ALCO session, I will pour through your policies, your ALCO package, and I will come up with what I think are reasonable strategies to consider, reasonable policies to consider, and we'll talk about loan and pricing initiatives, right? We'll talk a little bit about derivatives if you want, right? I'll give you an outside perspective, independent on your risk position. And then last but not least, we'll talk about NAV issues if they exist, or if you think about taking on some of these strategies, how's that going to impact my NAV? I actually put a little template together, if anybody wants it, that you can just plug in. You can plug in a 30-year mortgage back of X at this yield. What's the impact to my NAV? If in the base case, rates up 1, 2, and 3, and 4. And can I support that from an NAV supervisory perspective, right? So that's the end of my presentation. You know what? We've got a half hour to talk about what's on your mind. So at this point, Angel, thank you. Let's open this up to questions and see what's on everybody else's mind. Hopefully we'll have some dialogue. Don't be shy. It's Friday.
Thank you, Frank. Thank you, Frank. I just want to remind everyone to use the box on the screen to enter your questions, and Frank will go through the answers for you.
I don't know who these questions are coming from, so you're anonymous. Just feel free. And if I don't have any questions, I'm going to make some up, because I know it's on. I know what you guys are thinking. It's just a matter of, are we comfortable reaching out and asking the question? I'll ask a question, right? I'll ask a question. I know some of you, because I've spoken to some of you and I've helped you put together some potential solutions for getting through some of the regulatory issues that you're dealing with now, stemming from those medallions, taxi cab medallions. One of the things that we've seen in the banking industry, going back to the late 80s, early 90s. I was a regulator back then, and it was what we called the death spiral for banks that were having some loan challenges, having to add to their reserves, and the death spiral goes like this. We've got to increase our capital ratio. How do you increase your capital ratio when you're struggling with loan problems? You got to continue to add to reserves and get the capital ratio up. Well, what do? You sell off the best assets that still have value in them, and that helps to prop up, right, our capital, right? Particularly if you can get some gains, right? And then you can shrink the balance sheet. And so temporarily, we got more capital from gains and from shrinking the balance sheet. So once you do that, what's left? Not the great assets, right? And then typically what happens is then your income goes down. That starts to eat into capital, and ultimately we're out of business. If some of you are in a situation where you feel as if you have no choice, right? You've got to continue to shrink to get your capital ratio up because of that challenge. You know what? I would fight tooth and nail before I did anything to exacerbate the capital at risk at the credit union. And I would put together a plan. And I would say, here's our plan. We're not going to get out of this thing overnight. It's going to take some time. But here's our game plan. Here's what we're going to do, and here's how we're going to do it. And if you put that plan together, right, I'll take a look at what you're doing if you want. I'll show you some things that we've done with some others. You need a little forbearance, from a regulatory perspective. And the only way you're going to get that is you got to put a plan in place that's reasonable, rational, that's defensible, and it is doable. And it's going to get more and more challenging as rates fall because margins are likely to get squeezed, right? So if that's something I can help you with, then I'd be more than happy to do that. Here's another question. With interest rates at historical lows still, what if you're wrong and rates do rise? Then you're underwater on long-term assets that you put on using this plan. And then it says something about S&Ls. Okay. All right. Well, let me break this thing down. If I'm wrong, well, I hope I am wrong. I really do hope I am wrong. I hope rates don't stay down or go down, right? Everything that we talked about from a strategy perspective was not based upon my outlook for interest rates. So I'm glad you brought that up. It doesn't matter what I think. What matters is if interest rates go up or interest rates go down, what's the impact to your income, right? And if you think about some of the strategies that I talked about, which was extending out on the asset side, right, and keeping my funding short, those were not made within the context of a rate bet or forecast. Those were made based upon the situation or the interest rate risk position of each and every one of your respective credit unions. And one of the things I showed was in the worst case scenario, from an incremental income perspective, when I showed you that, and I went to extremes to make a point, right? 30-year fixed rate jumbo mortgage-backed securities at the time right? What's the worst that can happen if I fund those things short? Well, it depends. You know, right now, those things have monster gains in them, right? But if I'm asset sensitive and I've got exposure to falling rates, I'm not so happy right now. I'm not relying on that mortgage-backed security to get me through a falling interest rate environment. Conversely, right, I showed you the worst case scenario of an up 400 basis point rise in rates over 24 months. That was still net a more profitable transaction than staying short, right? Because of all the cash flows that pour in and recycle up. So I showed you that the worst case scenario from an incremental perspective is rates go up 400. We make a lot more on the transaction if rates fell. But look at the rest of the balance sheet. Rest of the balance sheet is getting smoked. What's the other thing that we looked at? I looked at that core funding utilization. And right now, for most of you, I haven't seen one credit union, other ones I work with, that have a core funding utilization over probably 50 to 60%. That's why you're so asset sensitive. You have all these short-term repricing assets, right, at low yields that are funded by long-term non-rate sensitive funding that costs you hardly anything. So if anything, there's a bet in your balance sheet that rates are going higher. And if they do, you might benefit, significantly. But if you're wrong, right, what's the impact of that? So, that's a long-winded way of saying, the strategies that we talked about were not based upon a rate forecast. They were based upon, right, the impact that it has to each one of your, balance sheets. So I hope, right, I hope I answered your question. I'd be happy to, send me an email or whatever, but there is something in there about the S&Ls. One of the things I can tell you is I was a regulator and I dealt with S&Ls, right? And this is when the Federal Home Loan Bank was a two-part bank. They were banker and regulator. And if you look back at the S&L, I'll call it crisis, right? I would challenge you to show me credit unions that failed because of interest rate risk. I ask the regulators all the time. Nobody's come up with one. What was it? It was fraud, right? It had very little to do with interest rates. Most of the bank failures in this country had to do with fraud and bad credit, right? It was the credit risk and it was the fraud. If you look at the credit union industry, right? Heck, I can show you, and this might be a sore subject for some of you, I could show you that NAV test and NAV supervisory test for all of those credit unions that had taxi medallion loans. Because keep in mind, NAV has nothing at all to do with earnings, and it has nothing at all to do with credit risk. And so all these short-term repricing assets that look great from an NAV perspective had high credit risk. Same thing with auto loans, indirect auto loans. We see those problems, right? Interest rate risk is not going to put you under. It's the credit risk. Always remember that. And interest rates go in cycles. And at the end of the day, our responsibility, my job, the reason people hire me to come in is to help them to manage their risk. Not maximize it, not minimize it, but optimize it. No, manage the risk. And when you look at a balance sheet that does extremely well in one direction and gets smoked in another direction, by definition, there's an inherent bet in the balance sheet. And we just need to smooth out, that income stream and protect against rates going one way or the other. And by the way, that's why you have policy guidelines, right? Okay, so that was a long answer to a simple question. Anybody else have questions? And thank you, by the way. Thank you for asking that, because I know that that's on the mind of a lot of people. I know it is, and particularly board members, and particularly regulators, right? I deal with them all the time, more than I'd like to admit. But any other questions? Try to think of some of the questions that we had from the last session. People asked about borrowing limits. We talked about that. Let me ask a question. How many of you are prepared for a falling interest rate environment? How many of you even thought about a falling interest rate environment? How many of you truly understand and appreciate the impact of a falling interest rate environment? we've been, one of the things that, we know from experience is a falling interest rate environment generally comes with not just lower investment yields and a lot of option risk, people prepay, but it also comes with generally credit-related challenges, right? So how do we offset some of those risks? And while some of you might never ever put on a 30-year fixed rate jumbo mortgage-backed security, right? I can tell you right now that in a falling interest rate environment, you'll have some pretty decent gains in those that help to offset maybe some of the credit challenges that you have in the loan portfolio. So it kind of, helps serve as an insurance policy against that falling rate environment. Wow, quiet group, just that one question. I know this is unusual. We've got 20 minutes. Angel, Tom, anybody? You guys have any thoughts or questions on anything that you guys are seeing out there in the membership on the road in your travels that you want to talk about, where I can be helpful?
Frank, what I've heard recently is obviously the challenges that credit unions are having. I know we're focusing more on the curve and straight risk. However, on the lending side, any thoughts on that, ideas for credit union members as we move forward in 2019?
Yeah, well, if you think about some of the challenges on the lending side, right? My first question would be, okay, are we talking about auto, indirect auto, residential, commercial, business, et cetera? I think it's probably all the above, right? All the above. So that begs the question, what are some things that we can do to generate more volume? Well, let's just start with the auto, right? How do you generate more auto? One of the things I could tell you is, for a lot of the clients I work with that do auto, they would prefer to do less volume at higher rates than to try to keep that machine going at some of these low discounted rates. I don't know how some people. I got a car back in December, and through my credit union, I got a 1.99% 5-year car loan. I almost wanted to call the credit union up afterwards and say, when you see me showing up borrowing money, right, it's probably too low, right? So what's hard is, how do I grow volume in the auto sector when there's a lot of irrational pricing in the marketplace? And if I do want to drive the volume, you almost have to give the store away, right? What else? On the residential side, in New York, right, part of the problem, depending on what part of New York you're in, is there's inventory. What about inventory? There's not a lot of inventory. The places where there are a lot of inventory showing up now, you're starting to see some cracks in the credit, in the values, right? Like Long Island, right? So I know of a lender that they require 30% down in that part of New York, right? Because of some of the values. It's a fixed rate market today. I was on the phone this morning with a client, and they said, you know what? We've got a competitor down the road that, no matter what the secondary market rate is, they shave 1/8 of a point off. And it's a big, big bank. How do I compete against that? Well, you've got to make the decision. I said, I'll tell you what I would do. I would offer out the same mortgage product, and I would offer them, I would call it I made up a name, right? And said, that would be my promotion, which says, anytime between now and closing, you can take advantage of a lower rate if rates fall. And I said, it's an option that most people aren't going to take, right? It's an option most people aren't going to take, and that rate would be, a 1/16 to 1/8 above secondary market, so that if rates really drop, I can turn around, peel it off, and sell it, either through the home loan bank or secondary market at a gain, right? For every little incremental eighth I get in yield, I get a 5/8 gain. So that's like a free option that the borrower gets, that if rates fall, right, you turn around and you honor that. So they said, that's a great idea. I hadn't thought about that. I said, that'll work. That will work. Hybrid arms, right? Come out with a hybrid arm. If you really think that and are concerned about falling interest rates, I gave them some ideas for hybrid arms, 3 3s, 5 5s, and I threw out a rate. And I said, that will get you volume. How do I know? Because I work with some of the largest originators of mortgages in the credit union industry, and I know what rates they charge, and I know what works, and I see what volume works and what volume doesn't work. So I'm like little Johnny Appleseed. And as long as I'm not in their backyard, I don't mind sharing those rates. I'm going to share those with the competitors, but that's another thing that you could do. On the commercial side or business side, think about the inversion in the yield curve. If you have access to derivatives, if you look out on the yield curve, oh geez, now about 6 questions just came in. So I'll finish this one quickly. If I look out on the time horizon, I can actually lock in rates for takedown 6 months from now at a lower rate than if I borrow the funding today. That's pretty interesting. I might go out to my business customers or customers I didn't get last time around on the business side. I'll give you a 5-year, a 7-year, a 10-year, a 15-year fixed rate. I'll give you a fully amortizing 20-year fixed rate commercial loan, and I'll lock in the rate today for 6 months down the road when the other one comes due. And here's the rate. And you give me a fee up front, and all I have to do is pick up the phone, execute a swap. And with the new accounting rules now for derivatives, which I think I talked about last time, right? I don't want to get bogged down today, but the new accounting rules make it so easy and simple to do that. For some of the credit unions on the phone, they don't even need to put on a swap. They can just book it. That's another thing I might think about and consider. All the loans that are coming due throughout 2019 that are either business loans or commercial related loans, if they're going to reset within the year, why not reach out to them now? You could probably get a premium on the rate by locking in the rate today. So, I mean, just another thing that I might think about. I mean, we could spend all day talking about lending strategies. Okay, let's see what this says. That's no thoughts on participation. Mentioned earlier in the presentation that ratios were limiting opportunity. What is your recommendation as it relates to a rate of funding, deposits and or wholesale funding to loans? Okay. In particular, commercial participations. Okay, so let me just think about this. You mentioned earlier in the presentation that ratios were limiting opportunity. What is your recommendation as it relates to a ratio of funding, deposits? Oh, deposits to loans. Okay, deposits to loans. Well, let's just start with deposits to loans. When I think about the wholesale funding side, I tend to think in terms of, as a percentage of assets, right? So NCUA limit is 50%. I would have no problem having a limit or a guideline of 35% to 40% wholesale funding to assets. I think there's going to be a percentage of deposits, which I think is the question. I don't know that I necessarily focus on deposits, but I'd probably back into that number. And again, at the end of the day, what's important is, can I defend my position? Do I have a process in place that demonstrates that what would cause any issues relative to my liquidity position, right? And I'm going to have early warning triggers, level 1, level 2, level 3 of those things that might trigger a liquidity situation. And that way, when the regulators come in, they say, well, what would happen in this? What would happen if that happened? I've already thought that thing through. And here's the early warning triggers. Here's what we would do from a contingency standpoint. And here is the step-by-step process that we would go by. And then probably as important, if nothing else, more than anything else, is to run a relief scenario. Show me how that impacts your liquidity, and then show me the relief scenario to get you back to within policy. And all that stuff is easy to do if you've got the right tools. All the tools are available. They're not that expensive. And so that's probably what I would focus on. And then somebody asked, in particular, commercial participations. Well, that's a question. In particular, commercial participations.
Yeah, Frank, it looks like you're asking if you could provide your thoughts on participation durations.
Okay.
Particularly with the commercial participations.
Okay, so when we talk about participation duration, in other words, if I'm participating in commercial loans, how far out should I go? And I guess, you know what? If it's credit worthy, you know, do I really care how far out the loan is? If I'm comfortable with the credit, does it really make a difference if it's 3 years, 5 years, 7 years, 10 years? You know what? If it's a good solid credit, whether you have it for 5 years or 10 years, you know, I don't think your credit. I mean, you're in the game. You're basically an equity player. So I don't know that the duration necessarily has an impact on what I would do from a participation, whether it's 3, 5, 7, 10, 15. And I don't know if it's a credit-related question or if that's an interest rate risk-related question. Interest rate risk is easy to manage. Again, we can do that through, you can do that through swaps. You could just do it through, you know, natural hedges you have in your balance sheet in the form of non-rate sensitive core funding. I talked about that core funding utilization. So I don't know if it's credit related or interest rate risk, but if it's interest rate risk, I'm less concerned about the duration. It's all about the credit quality. So I hope I answered that question. And if not, you know, I think my email's on the front of this thing. Send me an email or call me. I'm happy to walk through any of these issues, you know, one-on-one, but and I think that's, oh, I see. That's participation duration. Yeah, so I hope that answered that particular question. And if not, you know, type it in again. Good. I'm glad. That was a good question. That's a very good question.
Yeah, Frank, it looks like we've covered all the questions. Is there anything else you'd like to cover before we wrap up?
You know what? I think most people at this point, Angel, probably had enough of me. But I'm always available. You know, I just want to say thank you for, you know, to the Home Loan Bank for allowing me to participate, you know, with your members. And I know you guys really care, and I know you spend a lot of time to try to bring value to the membership. And I hope we brought some value to the membership today. And one of the things that you know, is, you know, near and dear to my heart is to help the membership. And I hear stories from, you know, you guys when you come back from some of your calls and you said, you know, we gotten a lot of mileage out of that last seminar, and here's some of the things that the members are doing. And you know what? When I hear that, it really makes a big difference. And I hope sincerely that, you know, some of the ideas that we talked about today are embraced and you run with them. And, you know, if I can help out in any way, you know, please reach out to me. And that's why, you know, at the end of this thing, you know, I put, you know, I'm happy to run one of these little complimentary strategic ALCO sessions. I'll just take whatever you guys are doing, take a look at it and give you my thoughts. Anything I can do to help you guys, you know what, please, you know, don't be shy. Let me know. So that's it on my end. And again, thank you so much for all of you that participated. I know you've got other things that you can do with your time, particularly on a Friday. So I appreciate you hanging in there as long as you have. Thank you.
Thank you. And I want to also thank everyone for taking your time to attend today's webinar. And again, as Frank mentioned, if there's any questions, please reach out to Frank or myself about anything we discussed today, any of the topics, or if you need any additional information. Thank you again for joining us today.